As gold continues to break through milestone after milestone, some analysts and media personalities are making bold predictions. But is there any real basis for claims that gold could reach $12,000 per troy ounce? A bit of skepticism is always healthy in these situations. Today we're going to break down two key methods analysts use to predict these lofty price targets and explore whether they hold any weight. If you want the stories and insights no one else delivers about precious metals, hit that subscribe button and support the channel. Thank you. All this hype around gold reminds us of another recent craze. A few years ago, Redditors began a campaign of attrition against hedge funds who had been shorting GameStop stock. Hedge funds were using a strategy called naked short selling, which allowed them to artificially drive the stock's value down. Hedge funds were selling stock they did not own and had not borrowed. Redditors retaliated by buying a large amount of stock, forcing the hedge funds to cover their losses by buying stocks they had shorted. The result was a massive increase in GameStop's value, climbing from a pithy value under $20 per share to roughly $500 per share in the craze. The event, orchestrated by a subreddit called Wall Street Bets, was hailed as a David and Goliath battle. Almost overnight, the word short squeeze became a household term. They say imitation is the sincerest form of flattery, and before the month had ended, Wall Street Silver was born on Reddit. Their tagline? Home of the Silver Squeeze. Denizens of Wall Street Silver believed the silver vaults at the exchanges were nearly dry, and that by investing in a coordinated fashion, they could drain the remainder and break the paper market. In effect, they intended to create a type of short squeeze tailored to the unique structure of commodities trading. Wild predictions of silver's potential value graced headlines for months in anticipation of a silver squeeze. People predicted silver at $100, $300, and even $1,000 per troy ounce, while silver hovered below $25. The squeeze never materialized. And today, with gold rallying to new all-time highs, some of the headlines predicting gold's future have an air of familiarity. Just as silver headlines predicted returns with jaw-dropping multiples, guesses about future gold prices are stretching into the realm of speculation. To be fair, there is some logic to these price predictions, but there are counter-arguments to be made as well. The logic behind the silver predictions are both similar and dissimilar to the logic behind gold's price predictions. Silver bulls look to the period between 1970 and 1980 when silver entered a long bull market. It began at a low of $1.31 in October 1979 and peaked at a high of $49 per troy ounce in 1980. This was a 37x return. If silver could do it once, surely it could do it again, couldn't it? The arguments for gold reaching $10,000 or $12,000 or more follow the same logic. If gold could run from $300 per troy ounce in the year 2000 to over $1,800 per troy ounce in 2011, couldn't gold do the same thing again? This would be more than a six-fold increase. Now, if you're talking about $2,000 gold when some of these predictions were made, then it almost seems reasonable to predict $12,000 an ounce gold. You can start to see the similarities between silver's price predictions and gold's. We think it's important to point out that the silver run up to $49 an ounce in 1980 was the result of serious manipulation by the Hunt brothers. A pair of wealthy heirs attempted to corner the silver market, and the aftermath of their miscalculation lives in infamy as Silver Thursday. Prognosticators fail to mention that immediately after this run on silver, spot prices collapsed, leaving investors no time to make good on the wild valuations. And similar to the events of 1980, investors predicting the price of gold may be failing to account for the global financial crisis in 2008. After the banking collapse, a number of emergency measures were put in place to help people and businesses recover. One measure was a great deal of quantitative easing. which is a fancy way of saying just print more money. Quantitative easing added billions of dollars to the money supply over the course of a few years. Of course, investors expected inflation to follow, and gold prices reacted accordingly. If we look at the time between 2000 and 2008, gold prices did grow rapidly. The value of a troy ounce either doubled or tripled depending on what time frame you look at. If we were to apply that same logic to our current prices, we would assume that gold would eventually peak between $3,500 and $5,400 per troy ounce, unless a black swan event prompted additional growth. This is still a large increase in value, but a far cry from the 5-digit forecast published by various news outlets and analysts. Apart from historical price movements, there is another technical analysis prompting lofty targets. We're talking about the cup and handle. This technical analysis pattern often appears when there's a consolidation period followed by a breakout. The cup forms when prices experience a dip, then recover over time, creating a rounded shape. Think of it as the market catching its breath. Once gold regains its previous high, the price tends to pull back slightly, forming the handle. This brief dip clears out investors looking to take quick profits. If the price breaks above the handle, that's usually a strong signal of further gains ahead. Many traders use the cup and handle to predict future price increases, and for gold, it could indicate that the market is positioning to a breakout to new highs. While it's not a guarantee, it's a pattern worth paying attention to, especially if gold continues to react to inflation or unexpected events. Gold has exhibited several cup and handle patterns in the recent past, but the one generating excitement is a 13-year cup and handle pattern. This tends to be a reliably bullish signal and is the basis for many of the forecasts predicting gold rising to new all-time highs. With the cup and handle analysis, the forecasts tend to be more modest in comparison, with a predicted rise in gold spot to land somewhere between $3,000 and $4,000 an ounce. Forecasts from more conservative institutions, like the Bank of America and Citibank, predict gold reaching $3,000 per ounce either by 2025 or by the end of 2025. This seems to be in line with the forecast from analysts using the cup and handle pattern to predict a breakout. But as most honest analysts will tell you, this chart pattern is not perfectly accurate. There are instances where it has appeared yet no significant breakout followed. We don't pretend to have a crystal ball, and we don't take a position on where gold prices are heading or could head. But wise men tell us if something sounds too good to be true, it most likely is. Gold suddenly rising to $12,000 or more virtually overnight is an exciting headline, but it's smart to carefully consider its likelihood before making any serious commitments. In today's world, with assets like Bitcoin and GameStop stock generating eye-popping charts, it's tempting to think of commodities like gold or silver as the next big thing. The recency of these events tends to lull some people into believing it's more common than it really is, a phenomenon known by psychologists as recency bias. But what do you think? Drop us a comment down below and let us know what your price predictions are for gold and whether you're currently holding, selling, or stacking. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.